friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends, former investment bankers, and teachers here to give you the skinny on how to land and thrive in the world's highest paying jobs. Today, we're bringing back a friend from a prior episode, Carissa Jordan, who was in our incredible episode about problematic female managers. That was episode 55. If you haven't listened, please go back and listen. Carissa was a credit trader at Goldman Sachs, and she's here to give us our long-awaited Credit Trading 101 episode. And one of the things that I think is so cool about this episode is Carissa doesn't just give us the narrow perspective of a trader sitting on a trading desk at an investment bank. We're going to discuss everything about credit from its conception and origination in the investment banking division. We're going to go through what happens in the debt capital markets and syndicate group, and then come out on the investment grade, high yield, and distressed trading desks at the other side on the sales and trading division. At the end, we're going to touch a little bit on credit derivatives, but we'll have a full separate episode on those later. We're going to talk about the lifestyle on a credit desk, and we're really going to get into some of the nitty gritty mechanics of how these bonds trade. This is also a great companion to our other podcast, which is the unofficial companion guide to HBO Max's hit show Industry, because understanding the basics of credit is going to help you understand a lot of the plot points that we touched on in our episode that we just released yesterday. We've moved all of our content on Industry over to its own dedicated separate podcast that you should immediately subscribe to. And this one's going to remain our educational focus, where we're going to bring industry thought leaders on along the way. And then we still have the skinny on Wall Street. We just brought that back from the dead after a couple of weeks hiatus, where we're going to be talking about current market moving events and deals in the news.
Yeah, I do want to add, though, I think that for anyone interested in more, I don't want to say of the lifestyle, but just honestly, I think that there is no better way to understand the mechanics and just what it's like in sales and trading, and actually the products, like, than learning it through storytelling and through this show. This show is amazing, and they get so, we talked about this, like, they get so much right, and they get so in the weeds. Like, so this last episode, I mean, my God, it's, by the way, it was 2 hours long, and there's only so much you can talk about the plot. So yes, we talk about the plot, we talk about the sex, we talk about the drugs, we talk about just some of the, again, the interconnections with the characters. But for people who like actually want to learn this stuff, I mean, Jen had like a PhD level thesis about, you know, the nuances of like this FX trade and like sales credits and how salespeople get paid and how traders get paid and the nuances of the desk and the dynamics of like bringing money into the firm and the clients. And it's, I can't like overstate enough. Like, it is just so helpful if you're at all interested in the markets, trading, and it's really worth the show is worth a watch, and the companion podcast is worth an absolute listen. Like, anyone who's interested, get on it. The link will be in our show notes, because when it's a little baby podcast, so I think sometimes it doesn't show up that easily in search. So we will be putting the link in the show notes, so you can find it on Spotify, on Apple, and then we do always post. This is another plug. We do always post the video component to the podcast. You can see me and Jen in whatever state we are in. Jen is like always bopping around in some other location, but we do post the video on YouTube. So if you wanted to watch, I know that some of our international listeners have asked for this because it's sometimes hard. We talk very fast. And so we're getting into technical stuff. It could be helpful to actually read. Granted, I don't know how well the translation is in YouTube, but still, it's better than nothing. So definitely check that out if you are someone who wants to see the video. So that's my little plug there.
No, I think that's awesome. It's funny. I was actually talking to Carissa, our podcast guest, this morning, and she was like, I can't wait to listen to the latest episode of your Industry podcast, but I've got my kids with me. It's not PG rated, is it? And I was like, absolutely not. The Wall Street Skinny, our podcast here, the big podcast, we've got an explicit rating. Whatever the rating is for our Industry podcast should be one level up from that. So,
and for the record,
listener beware.
Well, the reason we do the explicit rating on this one is literally just because we don't want to be super cognizant of just like swear words. Every once in a while we'll swear, but it was actually funny. One of my good friends who was on our podcast, the Bankers versus Doctors podcast, they were like, yeah, we were going to listen to it in the car, but we, because they have 3 kids. She's like, but we were worried it was, it had an explicit rating. And I was like, no, that's actually fine for you guys to listen. Like, that's not, but there might be a swear word. So that's why we put that on. The Industry, like, no, no. That's
You
all.
know what needs an explicit rating is my phone calls with you in the car. I swear to God, guys, whenever Kristen and I talk in person, she's like, oh, phooey, darn it, I stubbed my toe. We get in the car and I call her sometimes when I have my kids in the car, and she is cursing like a sailor, and it's without fail. And my poor kids are like, what is she saying? I'm like, nothing.
But I censor myself every other time. I'm like talking to you. I'm like, oh, F, like, oh, darn it. And then like with your kids, I swear to God, I only swear when your kids are in the car. It's like
you can
tick.
set a clock by it.
I would know that your kids were in the car because I would start swearing. But yeah.
And so just a heads up too on programming going forward for us. We'll be here next week. We'll be out of office the week after when we're at the Case Summit, which we talked about on the Skinny on. And that's going to be an unbelievable opportunity for us to talk to and have first-person access to some of the biggest thought leaders in the industry. Mark Rowan is headlining it. You've got
CEO
Todd
of Apollo.
Bowley. Yeah, a number of people there who are just really big names in the industry. So, I mean, we'll probably be those fangirls in the corner being like, hey guys, hey, talk to us, like whatever. But I actually think that we'll have some really great content. We've got a lot of great interviews lined up. So we may not have our regular long form hour-long episode 2 Saturdays from now. It may be a combination of some of that content from the Case Summit.
We're recording 3 podcasts next week, Jen. So there's a lot on the schedule for next week. Yeah. Mm-hmm.
Well, then let's ditch all that I just said, because that doesn't make any sense. I completely forgot. Guys, listen, true story. It's 1:54 p.m. This morning. We got an email at 7:30 from someone named Madison. And then 5 minutes later, I got an email from someone else named Madison. And I'm writing back to each of them as though I'm talking to the other person and not paying attention to which Madison I'm talking to. So I am clearly so out of touch with my own calendar. I barely even know my own name at this point. So I appreciate you guys bearing with me as I have my temporary moments of insanity. We will have more than enough podcasts, apparently, to be able to give you guys great content. So ignore everything I said. Thank you so much for correcting me there, Kristen. And let's bring Carissa on.
Awesome.
All right, so we are back with Carissa Jordan, bestie of the Wall Street Skinny, who was on a previous episode that we did talking about female managers on Wall Street. And we had such wonderful feedback from our community on Carissa's contribution. We have brought her back to do the 101 on credit trading. Carissa, in case you don't remember, traded credit at Goldman Sachs. And we have talked so much about credit investing from different aspects on this podcast, but we've never actually properly defined credit. What is credit? What does it mean to trade credit? What are the different products? Who are the players? How does it all work? So today we're going to get into it with Carissa Jordan, who is the co-founder of Benjamin Talks. And Carissa, when we say credit trading, what does that mean?
When we talk about credit, what we're referring to really is corporate bonds and corporate CDS, which is credit default swaps. When we think about bonds and we break it down a little bit further in the world of credit, you could think about leverage loans, investment grade credit, high yield credit, distressed credit, and then you have kind of these hybrid products, which are preferreds as well as converts. Now, typically converts tend to be traded either on a cross asset desk or on the equity side of the business, whereas preferreds sit within like the proper credit space.
Yeah. And just to recap, the converts are basically debt or preferred that is convertible into equities. Hence why it's kind of like this homeless product. When I was in converts, I was converts origination and capital markets, and we were on the equity side. But again, to your point, it's like because it's convertible into equity, it has a lot of the equity characteristics. I know you mentioned leverage loans, Carissa, and it's interesting. Like that's something that I remember always being so confused about what is the difference between like leverage loans versus a bond versus like a loan in general.
Yeah.
And the actual definition of leverage loans, it kind of varies depending on the rating agency you're talking to. But a loan is just a loan from a bank versus bonds are these, securities that are traded between people. So again, the loan is coming from the bank versus again, bonds are, you and I can invest, right? Or XYZ hedge fund and blah, 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 blah. So
that being said, a lot of CLOs, so collateralized loan obligations, buy levered loans, right? So they buy leveraged loans, they package them up and they slice them off and then they sell them out. So one of the main players in the leveraged loan space are CLOs.
Yeah.
Okay,
Which again, That's where I started my career in 2007 and took down the entire economy. But they do play a really important part of liquidity because the banks lend the money to different companies or whoever, and then they need more balance sheet, so they get this stuff off their books and they have more money to lend. So anyway, all right,
Exactly.
with that.
And so when we talk about these corporate bonds, my understanding is that the credit world is really broken up into the world of investment grade, the world of high yield, and the world of distressed. Can you give our listeners who might not be familiar with those three designations a little bit of understanding of what the difference is between those investment grade, high yield, and distressed bonds?
Sure. I'm going to just take a step back because I think it's important to define like what a bond is in plain English.
Yes.
And this is kind of how I would explain it to my 10-year-old, right? And is he going to understand all of it? No, but it's a good starting point. So when you think about the two main asset classes that investors look at, you think about equities or stocks and then bonds, fixed income or bonds, more specifically bonds. When you are an equity shareholder, you are an owner in a company. When you are a bond holder, you are a creditor, right? So you're basically lending the company money. Now, bonds and stocks differ in many different ways. One is that bonds sit at the top of the capital structure. So what does that mean? In the event of default, they're going to be the first to get paid back, right? So in that sense, they're considered a little bit less risky than equities. That's one way. The other way is that there's a set maturity. In theory, stocks can exist or equity can exist for a company indefinitely, right? But with bonds, there's a specific maturity. And maturity is the date at which the borrower has to pay back the principal to the lender. And maturities can vary. In investment grade, it's typically 5s, 10s, 30s. High yield, it's a little bit shorter term, and we'll get into this a little bit later. You get 5s, 7s, 10s. So there's a set maturity, a set date which you're going to receive your principal back. And then the third way that a bond differs from equities is that there's a set coupon. And yes, equities give a dividend, but a coupon is given semi-annually. And the rate at which that coupon is issued is, you know, that at issuance, right? So let's say it's 5% for 10 years. You're going to get that interest paid semi-annually. And then at the end of 10 years, you're going to get your principal back. So that's how bonds and equities differ in like the most basic way, right? And the way that the same reason why companies may issue equity is like similar to why they may issue a debt, right? Maybe they need to build out their R&D, research and development. Maybe they need to build new facilities, or sometimes they tap the bond market when they have to repay back existing maturities, right? So there's many different reasons why companies tap the bond market, but the main takeaway is bonds sit at the top of the capital structure. So they're going to be first to get paid back before equities in the event of default. Second is that they're perceived as less risky because they have that set maturity, the set coupon.
And typically as an investor, you likely have some recourse and recovery in the event of default.
Correct.
So unlike with equity, where generally speaking, if the company goes under, you get wiped out. If you are a secured creditor who is invested in one of these bonds, you may have recourse to whether it's the properties that the company owns, some kind of assets on their balance sheet that you are entitled to in the event of default, like you said.
Correct. And to go back to your point about secured, when you look at bonds, there's then different levels of bonds, right? So you have senior secured, senior unsecured, subordinated, right? So senior secured says just that. They're the top of the capital structure. And that bond, that asset is secured by assets of the company, right? And in some ways, those assets are defined within the covenants and the documents, and sometimes they're not. Senior unsecured is it's a senior, but it's unsecured. There's no specific assets that back that bond. And then you have subordinate and so on and so forth.
So and just to give people an idea, if we think back to the Caesar Palace coup, there were certain properties that the debt was secured with, where it's like you could get ownership of that asset. So that was what we mean when we say the secured. And I also wanted to just sort of pipe in on the equity side. It's funny because I always think from the perspective of the company issuing, because again, when I was in the capital market side, we were advising companies on like, should you issue debt? Should you issue equity? Should you do a convert? What type of convert? Whereas Whereas when Jen and I talk, Jen's thinking much more on the investor side. And I'm assuming, Carissa, you're probably the same way because you used to buy and trade this stuff. Like you're dealing with it in the secondary market. You don't necessarily care about why it was originated in the first place. But it is interesting that, again, to your point on the equity side, if you think about the reason that a company is going to issue equity, a lot of the times it's going to be because they might have to in certain cases. It used to be the financials had to have certain amounts of equity capital on their balance sheet in order to, maintain various ratios. It could be because they have people that want to cash out. We talked about, if you had like a private equity firm buy a business and then they ultimately want to IPO. So there's a lot of different reasons why you might do that. When you're thinking about the issuer versus the investor, it's like they're opposite sides of the same coin.
Yep.
So it's the coupon that the issuer is paying is the yield or the return that the investor is getting. Yeah.
And then I just want to go back to the difference between investment grade, high yield, and distressed.
Perfect.
So when we look at that, this is important to introduce the concept of rating agencies. So the rating agencies, the three main rating agencies are Standard & Poor's, Moody's, and Fitch. And what they do is they look at companies that are issuing debt and they assign them a rating. So at the top of the rating chart is AAA. And AAA is perceived as like very, very low risk, close to certain that they're going to not go bankrupt and they're going to pay back their debt. And then it goes AA, single A, triple B, double B, single B, triple C, and so on and so forth. D is default.
Yeah.
So very good question.
Cutoff? Yeah.
So typically speaking, anything triple A to triple B minus is considered investment grade. Double B plus and below is considered high yield. Now, there is some ambiguity in that triple B minus space, especially between companies that get upgraded or falling angels. So there is a little bit of ambiguity, but typically high yield starts at double B plus and below. Okay. And when you think about it, the mechanics of how the markets operate are different. Liquidity is different. Quoting is different. How you think about risk is different. There are a ton of similarities, right? It's the same product. It's bonds and CDS. But the way the markets operate, there are differences.
And just to be clear, the U.S., which typically is, when you think about it, the risk-free rate that we typically quote on U.S. Treasuries, right? The Treasury can print money to pay back our debt. Even the U.S. is no longer AAA rated.
Exactly.
And that's why our current fiscal policy. So it's very hard to achieve that AAA rating.
It's the perceived credit worthiness of a company. And I always like to say that it's perceived, right? And if we think back to like when we all started in 2008, there were a lot of investment grade companies that went bankrupt or had restructuring and so on and so forth. Those were investment grade companies. Those companies were not rated high yield. Even though they were trading like they were high yield, they were not high yield rated, right? They were investment grade rated. The other thing to note about rating agencies is they're somewhat backward looking, right? So they're working on data that's already been reported versus exactly in the moment financial state of a company. So that is something to note, but that's been the case forever. And it's slightly backward looking, right?
I always used to ask people when I would teach classes, I'd be like, do you know who the AAA rated companies are? Because there's only I think there's only two, although Apple did get upgraded, I think by one of the rating agencies, but the only two, it's like Microsoft and then Johnson & Johnson. Like everybody else is gone.
And when we talk about high yield, that's something that I think is worth defining why we call it high yield or why we sometimes call it junk for people who aren't familiar with credit terminology.
Yeah. So the word junk was definitely used in the 90s and early 2000s. There's been a migration away from that, and now it's
not
more
politically correct
known
anymore.
It's no longer politically correct. It's more known as high yield. And why is that? Well, it's higher yielding, right? Your yield on those bonds is higher than what they are on investment grade. And why is that? Well, these bonds are considered more risky. These companies are considered more risky. In some cases, these companies are private companies, meaning that they don't actually have public equity and they are just issuing bonds. In some cases, they're like really small public companies that have, stocks trading in like the single digit range, then they issue bonds. And other cases, they are very large companies, but have some sort of credit impairment that they're given that lower credit rating, right? Maybe they're very levered. Maybe they're a result of an LBO, right? Yeah. So they're given these lower ratings.
Yeah. And actually, I think that that's a really interesting point, which is like a lot of times the types of companies that are going to be issuing high yield bonds are companies that have been LBO'd by a private equity firm, right? Exactly. That's where those leveraged loans tend to come from. They tend to come from those leveraged buyouts. And then the high yield bonds are part of how they finance that deal. And so then they trade. It's like the equity might be private, but the bonds can still be public. So
Exactly. And then what you'll see is eventually some of those LBO companies will then issue stock again, right? At some point.
exactly.
So it's kind of this full circle that happens.
Yeah. Love that.
So all these different companies are issuing this debt. This debt gets issued via a new issue process and syndicated, underwritten by banks, syndicated out to investors. And then once those bonds are out there in the universe, a credit trading desk is making markets in them. Can you talk a little bit about who the investors are who play in these bonds in the secondary markets, again, after they've been issued, after they've been held for some period of time, whether it's a couple of hours by a hedge fund or a couple of years by a real money investor, and now they are trading
or a
in the
couple of
secondary
minutes
market.
or a couple of minutes. So that, when you, just to go back a little bit, we were talking about the syndicate desk. Like the syndicate desk actually sits between the investment banking group and the trading desk, right? So they are, again, they're a little bit more of a hybrid role. So they have a little bit more of a pulse on the market, but they're really involved in the underwriting process of these bonds. And that process is a little bit more fluid, right? Between the traders, especially in high yield, and the syndicate desk, right? So they want to know, okay, if this company is bringing debt, do they have existing bonds outstanding? Where are those existing bonds trading? Who are the big holders? What is their appetite for more risk from this company? And what are these bonds doing? Is this added leverage or are they repaying existing bonds? So like that's all part of the conversation and the dialogue that happens between the traders and the syndicate desk. So then the syndicate desk builds a book, right? And there's like the lead underwriter, and then there's the other people on the book. Typically, the lead underwriter will place majority of the bonds, right? And they're going to say, okay, Fidelity's getting X%, CalPERS is getting X%, and then so on and so forth. And then the trader who is at that lead underwriter, as well as the other book runners, will see a list of where are these bonds getting placed, and they'll actually have some input in that conversation, particularly on the faster money side, right? Because they know, okay, who's just doing this to kind of flip out of the risk, or who's actually going to trade it? What is their thesis? So the trader does play a role in that. So once the bond is brought to new issue, it breaks. It's called on break, right? So like it hits the market. The trader sends out the first run for the bond. This is like the first market being made. And then at that point, you could literally have just been allocated bonds 10 minutes ago and you may decide to flip, right? Yeah. It's part of the game. So who are the players? The players are real money. The players are fast money. So real money, you think of like your Fidelities, your BlackRocks of the world. You think of your ETFs, your money managers, and then you think of your hedge funds. Hedge funds also play a role in the bond space.
And they're the fast money that you're talking about.
Typically, they've been called fast money, yes. Something else that is recently starting to pick up a little bit more steam is that you are seeing a little bit more, and it wouldn't be in the new issue space, but retail investors are playing a little bit of a bigger role. And now with the sense of portfolio trading, what you're starting to see is the creation of SMAs, more specific for corporate bonds. So SMA is a separately managed account. You see this typically in the mutual fund side for high net worth and ultra high net worth individuals, right? Well, they'll have their own separately managed account for muni bonds. So instead of buying like a muni bond ETF or mutual fund, they have this SMA. So they actually own the underlying bonds, but it's in this managed portfolio that's managed by a PM. You're starting to see that pick up a little bit more on the corporate side of things as well.
Interesting.
And so these players come in, they buy these bonds, they sell them as they make profits if they're a hedge fund, or they need to raise liquidity to invest in something else or rebalance a portfolio, et cetera, et cetera. They're trading in the secondary market. How are they quoted?
Yeah, so that's a great question. So another difference between the equity markets and the fixed income markets, or a couple of differences, is like technically the bond market is open 24/7, right? There's no set exchange. It's called the over-the-counter market. There's no set place where these bonds are being traded, right? Like they're not traded on a specific exchange. So how do investors trade the bonds? They go to the trader. They go to the market maker. So they go to your Goldman, your Bank of America, your JP Morgan of the world, and they go to the trader and they ask for a market. And what is the market? The market is the price that the trader is willing to buy the bonds, the price that the trader is willing to sell the bonds. And then there's an indicated liquidity. So typically in investment grade, it's like 5 million. The markets usually work on 5 million. About in high yield, it's usually 2 million up. What we're seeing now, and what a big shift from when I was trading to now, is that back when I was trading, traders acted more as risk takers, whereas now traders are acting more as on the agency basis, right? So they're really trying to find those buyers and sellers at the same time where they're taking minimal balance sheet risk. So they quote the bonds, the bid, the ask, there's a spread between. In the case of an agency, the trader is buying at the bid, they're selling at the ask, they're taking that commission in the middle. And typically what that spread looks like now is, it's about a half point in high yield. But sometimes if
that's 100%, so like 500 basis,
50
50
basis
points.
points. 50 points. Yeah, 50 basis points. But what you're seeing now is that when traders are acting on the agency way, when they're just matching a buyer and a seller at the same time, they may make an eighth or a teeny or like 1/16. Sorry for the jargon. The commissions are really shrinking, right?
Of 8%.
And on
of
yes.
8%.
And on the investment grade side, investment grade has really become a little bit more equified, right? So it's a lot more liquid. You're seeing a lot more portfolio trading. So that's like the big buzzword of the moment. So back in the day when I was trading, you were trading more single CUSIP, right? There was a lot more single CUSIPs or
an identifier that is unique to
of a specific bond. Correct.
Got it, yeah.
Or you would have, your money managers of the world would put out BWICs and LWICs, a bid wanted in comp, offer wanted in comp. And traders would either choose to price out one or two bonds or the bonds they want on that list. They'd price out the whole list. But each desk would be awarded, or each trader would be awarded the bonds that they priced the best in the investor's favor.
Yep.
Whereas these portfolio trades now is these money managers are sending these portfolios over to the traders. And in some cases, there's a portfolio trader that's going to price out this whole portfolio, and they're going to price out the entire portfolio. They're going to look at third-party pricing called BVAL, and then they'll incorporate a bid ask in that and the commission that they want to take, but they're going to price out the overall portfolio. And
so
portfolio trading. Exactly. And portfolio trading now, I think they're saying that it's maybe amounting to about 10% of all trace volume. So trace is where you could see bond prices trading. It's not exactly there's a little bit of a lag, but like when a bond trades, it hits trace and you could see the price and the notional that was traded. And that you can see on Bloomberg.
Just to give you guys a sense of context, probably when you started, Carissa, maybe not, but pre-financial crisis, this was not a thing. There was no transparency around this stuff. And now, as a post-financial crisis reporting requirement, TRACE came into play. And TRACE reporting became required across most fixed income products. And the time lag that you have now has been getting compressed and compressed and compressed.
Exactly.
It used to be like 15 minutes, and then it was like 5 minutes, and now it's going to be like 2 seconds or whatever,
Exactly. That's true. So we did use trace and see trace, but there was much more of a lag than there is now. There's definitely more transparency in the bond space and the fixed income space in general, but even in credit, than there was when I was trading. There's all, like I said, a little bit more of this equification, like, equifying, like equities.
Like equities,
Specifically in the investment grade space, you have more of these portfolio trading, more algo trading, more systematic trading. That wasn't really the case when I was trading. So when I was trading, it was very much credit specific, line specific, like where can you offer XYZ 7.5s of 21, right? Yeah. And it was like very specific. And there was also
7.5 of 21. Would that be like 7.5 is the coupon?
That's the
and
coupon.
21 is the expiration?
Maturity.
Yeah, exactly. Is the maturity. Sorry. Yes, exactly.
Sorry, expiration. I'm like thinking options somehow.
Maturity.
Carissa, and one thing, the liquidity sizes that you mentioned, you said like 2 and 5 million flips in high yield. What about in investment grade? What's the liquidity like?
So my understanding is there's definitely more liquidity in investment grade, but 5 million on single CUSIPs is kind of like the norm. And that's my understanding just from, conversations I'm having and things I'm reading.
And to give
whatnot.
our listeners a sense, in the treasury market, a social size is like 100 million. They're incredibly small sizes relative to the rest of the fixed income market, specifically rates.
One quick follow-up is that, again, when we used to help private equity firms do leverage buyouts, one of the things that we would talk about is that you could only tap the high yield market if you needed to raise over a certain amount of debt. So like you would have to be raising, say, at least $200 million of high yield bonds. Less than that, you're not going to be able to tap the high yield market. You're probably going to have to either do like a subordinated loan or a second lien loan
Yeah, what happens is those bonds, like the liquidity becomes really, really scarce, and there's like no real secondary market. So I think I want to say maybe the smallest issue I ever traded, the amount outstanding was like 150 million. But you have to assume that that's basically being put in the hands of, a couple of key money managers, and like you're never seeing those bonds again. That is why there is like these liquidity constraints. That compounded with the fact of, banks want to have smaller balance sheets. I think another trend that I'm hearing is that a lot of desks, there's like a juniorization on desks. So you have junior risk takers. So people who have not been trading since the great financial crisis, right? So like they're not used to taking on big size. They're limited on the amount of risk taking they can take and the amount of balance sheet they could take, right? So desks are much more inclined to act on those agency basis or doing these portfolio trading where then they have a lot of data around like how are they going to work out of this or how are they going to unwind this. They're making a specific bid ask on it. So I think all of those shifts is really why we are where we are today versus where we were 10 to 15 years ago.
And when you talk about balance sheet, for our listeners who haven't really put much thought into this, if you're not used to working on a fixed income desk at a bank, you don't really think about what that means from a balance sheet standpoint. Can you walk through a little bit how banks actually operate on this standpoint? When we talk about real money, we're talking about if you have $100, you are investing very close to $100 in that bond. If you are a bank, however, and you are buying a bond, can you explain what that looks like on their balance sheet?
Yeah. So if they're buying a bond or selling a bond, right, like that's going to sit on their balance sheet. That's going to be their assets and or liabilities on their balance sheet. And like there are many different risk metrics that banks look at to determine how big of a balance sheet and what kind of risk they're willing to take, right? So it's not only just the balance sheet, but it's like it's going to be their default risk. It's going to be their duration. It's going to be their DV01. When you're looking at credit, it could be jump to default. That was another big one that we would look at. Recovery rate, recovery risk.
What
And
is jump
all
to
those,
default?
it's basically like if a company went bankrupt today, how much money would you, trader Kristen, lose or make, right? Given your overall position. That's like in its most simplified terms, right? It's obviously more to it than that, but that's in its most simplified terms. So really, since Volcker, banks have been really focused on their balance sheet and they don't want to take huge balance sheet risk anymore. So whereas you could have, and banks would be comfortable with you owning or being short 50 million of a certain bond 10 years ago, they're not as comfortable with that today, right? There's a lot more rules in place.
And if you own 50 million of that bond, you're not just owning it outright, right? You're funding that. You are borrowing money in order to buy that bond.
So that's a great question. And from my experience and at Goldman, and I think this is the case at most banks, a lot of your macro hedging happens at the desk level. So Trader Carissa or Trader Kristen or Trader Jen isn't as focused on that. It happens more at the desk level. So we weren't even really. So basically, like they're at the desk, like at the investment grade level, at the high yield level.
Okay.
The overall macro risk is being kind of hedged at a more top level down, right? So like,
got it.
My job, like when I was trading, I wasn't really looking at how to hedge my funding costs, right?
Interesting.
Yeah, and I would say back when I was trading though, if you were getting short a bond, like if there was only 200 million outstanding, you would have to go and locate the borrow. So you would call your sec lending desk and say like, "Hey, can I get a borrow on this?" Right? Because then that does impact, the profitability of that trade.
Yeah. I also think too, in the current credit environment where rates are so high, right, and there's like actual carry implications versus when funding rates were zero, it's a very different environment now. So that's probably something to take into account as well.
Yeah, that makes sense.
And on the high yield side, remember when you're trading high yield, you're trading on dollar price. You're not trading rates. We're in investment grade.
Yeah, I want
like a big. So if I am an investor and I'm coming in for a quote on some investment grade bonds or some high yield bonds or some distressed debt, what do those quoting conventions look like and what are you actually quoting?
Yeah, so in investment grade, you're trading on basis points spread, so treasuries, and whereas in high yield, you're trading in price.
So it's like
dollar price.
Like
80. Exactly. And this is when, price and yield, inverse relationship.
Yeah.
If you are a trader and you're the market maker for investment grade, the basis points that you're quoting for the bid is actually higher than the basis points that you're quoting for the offer, right? Price and yield. Right. Important to note that. Whereas in high yield, it's very straightforward. It's bond price. So it's, 99 at 99.5, for example.
Okay. Question. With distressed, because you were saying that when you were trading, you kind of did everything. You could have investment grade companies that are, to your point, fallen angels and are now distressed. You could also have high yield companies that are like always, or maybe a little sketchy and then are distressed. Where is the line to distressed, and like how are those quoted? Is if they're
Great
a fallen
question.
angel, are they quoted differently, or how does that work?
Great question. So I never traded distressed. Distressed was its own kind of desk, and that desk looked a little bit different. So that desk was also staffed with lawyers who were going and reading through docs nonstop.
Wait,
right?
that's a
Especially,
really great point. I didn't know
yeah,
that. I didn't know that there were
yeah.
lawyers on the trading desk.
Yeah. Particularly like back in the day when you're talking about like Lehman claims, when you're
Yeah.
going through documents like all day long, like having a lawyer on the desk is super important, right?
Oh,
They're the ones
that's
who are
really
reading
good
all
to
the
know.
documents.
We
Yeah.
get
So that was
all the time about people who are attorneys who want to break in, and that's a great point of entry. If you are someone who has been a capital markets attorney and want to break into
bankruptcy. If you're a
bankruptcy
bankruptcy lawyer, or if you did any sort of capital markets on the lev fin side, that's a great entry point. I mean, even at hedge funds, there are portfolio managers who actually were bankruptcy lawyers first. I know one firsthand. So that is definitely a career path that's available. So with distress, it gets interesting, right? These are companies that are having a real credit impairment. They're not necessarily defaulted yet, but any defaulted company will also be traded by distressed. And typically how it works is either the distressed traders will raise their hand and be like, hey, this is getting really dicey. I have an edge. I know how to trade this. I'm going to trade it. Or, the desk manager decides like, this is getting really dicey. This needs to be traded off of the distressed desk, because the players are different, right?
Yeah.
Like you definitely have a lot more hedge funds involved in the distressed space than you do like real money. But real money is involved, right? Because sometimes they own these bonds and they have to work out of them. And again, distress is traded in price, right?
Okay.
Super distressed.
That makes sense. I feel like at that point, it's like, you're not going to quote 10,000 basis points, like 40,000 basis points. It's like, no, just call it 60% or 60.
Yeah, exactly.
And so going back to the investment grade trading mechanics. So you talked about quoting as a spread to treasuries because you said that there would be treasuries exchanged. Can you explain why that happens?
Right. So you have interest rate risk, right? With investment grade bonds, you have legit interest rate risk. And then you would want to hedge out that interest rate risk, right? So if you're a credit investor or a credit money manager, you really care about the credit. You want to have a view on the credit. You don't want to take an interest rate view. So you're going to hedge out your interest rates.
Yeah.
So that makes sense. If one of those money managers is buying the investment grade bond from you, they are going to turn around and sell treasuries against that on a DBO1 weighted basis to isolate that spread and effectively gain exposure only to that spread widening and tightening.
Correct. And sometimes, money managers will just trade the bonds and then it's up to the trader. So in this case, yes, in investment grade, the trader will then go out and hedge that rate risk. So that what they'll do is they'll either use an electronic trading platform or they'll call their own rates desk to hedge it out.
Yeah. And this might be obvious to a lot of people, but I just wanted to add this little nice data point in, which is that right now, as we think about, what's happening with rates, US Treasuries rates are higher, but credit spreads are actually quite tight.
Yeah,
so
they're at the tightest rate since 2007, which is very interesting if you think about that. But on an absolute return basis, they're still really high, right? Because of your interest rate risk. But the actual credit risk is very tight. And I will say default rates are kind of in line with historical averages. They're around 3%, which is, in line with historical averages.
So in other words, there's no reason why they should be this tight. Or do you have any idea like what's causing that?
Well, so much of why they are so tight is because of the absolute, we talked about this with Dominique Toublon, head of credit strategy at Barclays.
Yeah, the absolute
there is
return.
This wall of cash and there is yield-based buyers coming in en masse to buy these bonds on an outright basis, not selling treasuries against them. So they are just buying them on an outright basis. And that's keeping spreads artificially tight relative to the actual riskiness of market conditions.
Got it. Okay.
Well, but then also if you think about the riskiness of market conditions, like companies aren't going bankrupt at higher rates, right? They're going bankrupt at like historic rates.
Refi risk with rates being higher. So that's a riskiness element that persists, especially for some of the higher yielding stuff.
Correct.
Yeah, but that was one of the things that I forget if we talked about it on this podcast or if I was listening to one, but they were saying how it's like a lot of the banks are jumping in and doing this like amend and extend and allowing
Yes.
the companies to have more favorable rates because they don't want to end up with a bankrupt company, right? Or they don't want to end up, especially with some of the commercial real estate, like they don't want to own this freaking property. So they're like, sure, we'll just extend it.
Yeah.
So it is kind of an interesting that the whole dynamic right now is very interesting.
So I think we've covered cash trading pretty well. Now let's talk about the derivatives world. So can you explain what it's like trading credit derivatives and who plays in that market and what these credit derivatives are?
So the most typical credit derivative that's traded is credit default swaps. And when I was trading, you would trade single names. So similar to single QSIP, but you would trade single names. So, for example, when I was trading, I traded Frontier Communications, which is like, what the heck is that, right? It's like a landline provider. I don't even know if it exists anymore, but when I was trading, it did. And I would trade the bonds as well as the CDS. And the on-the-run CDS at that point was the 5-year. So that's the most liquid, the most quoted. And at that point, there were hundreds of single name CDS that traded. So each trader would trade both the bonds as well as the CDS for a sector or multiple sectors, right? What's happened in recent years is that the most liquid credit derivatives product are the indices. So the investment grade CDS index, the high yield CDS index. There's a financials index that's coming on soon that I'm being told, and that is going to be pretty liquid. From what I'm told is unless the name is within one of the indices, it's highly illiquid. So only the names in the indices now will even trade on a single name basis. When I was trading, we would actually quote 1 through 10 year CDS prices, and we would send out runs on that. Again, that has changed. You're also now seeing desks where they're taking the derivative trader and that becomes one role as opposed to spreading it out across all the sectors. There is still some of that. And also desks are pulling back from CDS trading in general, right? So like some desks just don't trade it at all. They are not market makers.
Yep.
While others, there are still market makers, and sometimes they're in their own kind of pod. Other times they will trade with the bonds. It's really bank specific how they want to structure the desks. But the most liquid product now are the indices.
And sorry, can we actually go back? I think we've defined CDS in other episodes, but for someone, if they haven't, recently listened and they're trying to get themselves just like caught up on when you're buying it, what is it giving you? What is CDS?
Yeah, I actually think Jen did a fantastic job on one of your reels explaining CDS. I thought it was perfect and cute and catchy. I think in its most simplified term, you could think of it as like an insurance contract. Like, why was CDS created in the first place? It was really to make bondholders whole in the event of default, right? So if you're a bondholder, depending on after bankruptcy, what the recovery is, you're going to get some portion of your principal back. And in theory, if you owned protection, you would get the difference between par and what you're getting paid back. So you would be made whole, right? In theory, you would get back 100% of your principal. So that was the whole theory behind CDS. It's now used as a tool to take a view on credit risk and also on like just spreads widening and tightening and market momentum, right?
I'd love if we could speak about the indices and how the indices work and why those are such liquid instruments, who the main players are and why they're trading them.
Yeah. So when you think about the indices, it's the most liquid credit derivatives product on the market now, right? So you have the investment grade and you have the high yield. There are some sub indices. The indices are comprised of
does that still trade? XO?
I don't know, but I remember that was a thing. That was a good one. So there is going to be this financials index that's going to hit the market. And basically what that means is that it's think of it as like any index, it's a basket of single names. And that's supposed to represent the overall market, right? And then it allows investors to take a view on the credit market in a more diversified way than buying single name CDS. And who are the players? I mean, it's the same players. You have real money, you have fast money, you have CVA desks. So CVA desks, they actually manage the credit risk for banks, and they'll actually trade single name CDS, right?
Yes.
But they'll also then trade indices. So they're also a player. Where there's been a big shift is that there used to be a lot more prop desks that would trade single name CDS as well as indices. Those desks no longer really exist. right? You would have basis traders who would trade single name CDS versus bonds, or who would look at, sometimes you would even have arb traders who would look at the difference between CDS, equity vol, CDS, equity options. Those desks are coming like far and few in between, like people that are actually like taking those views. And that's why single name CDS has become a lot less liquid. There's not enough demand for it. And banks, like I said, are not staffing their desks with traders trading single names. So there's also just less market making, less balance sheet providing, and as Wes, like there's like less players in the space. So people who are playing in the credit derivatives space are typically playing in the indices.
And so basically, if you actually need that protection, you're screwed.
I mean, listen, there's a price for everything, right? As we all know, there's a price for everything. Are you willing to pay that price is on you, but I'm sure you could find a desk that will price out anything for you.
I just find it funny though. It's like, the origination of why these things came to be is so that people who, bought the underlying bonds could have protection on whatever the name is. And now it's like, well, that's gone, but you can buy the indice. So I don't know. It's just, it's funny.
Can you talk to us about the lifestyle of a credit trader? What was your life like when you came in the morning? What would you be looking at during the day? What kind of inquiries would you be fielding? What were the stressful moments? What were the big successes? And, just what were your hours like? What was the lifestyle like? How often were you in front of clients? All that fun stuff.
Yeah. So, I want to take a step back a little bit. So I interned in sales and trading the summer of 2007 at Goldman, spent the last rotation on investment grade credit trading. I hit the desk July of 2008. So just to like paint the picture, it was a very wild time. And I think even just from when I started to when I left Goldman, the market changed a lot. So I'll give you a quick story. So when I was interning and for that last rotation on the investment grade desk, I was still living at home in Queens, taking the A train to downtown Manhattan. And at that point, all the mid-level traders were in by 6. Senior traders were in by like 6:15. So like if you were an analyst or a summer analyst, like you had to be in at like 5:30, right? And the job of the summer analyst, I remember we would print out copies of credit sites and the Gartman and get it on everyone's.
The amount of paper we wasted back in the day. Oh my God.
Crazy. So I would have to be like, to feel comfortable to be the first one in and getting all these printouts done, I would be in by 5:15, 5:30. So coming from Queens, I was up at 3:30 a.m. on a train at 4:15. And I did that for 3 weeks. And I was like, you know what? I want this job. I will get there. I will function on no sleep, right? So then fast forward to hitting the desk in 2008, we still had to be in like before 6, like right around 6. Again, because like the bond market is an over-the-counter market. In theory, you could trade 24/7. We would be getting calls from the London desk or the Hong Kong desk like that early in the morning. And you would even have like hedge funds in the seats by 6:30, like wanting markets, especially in 2008 and 2009. As the market kind of calmed down, that time to start was closer to like 6:45, 7. But you were still in early and your day ended while things would quiet down when the equity markets closed. Like you were still trading comfortably until 5 p.m., if not later. And then after 5 p.m., that's when you would read all your research. You would go over your P&L. You would go over your risk. You would go over your notes for the day. So like I would say like typically as like an analyst, your day would begin around 6 and end around 6. As you got a little bit more like senior and older, like those hours did definitely shift a bit, right? So, and the high yield market tended to open, and I use that term loosely, it would open a little bit later than investment grade, right? The start was like a little bit later. I would say like no one was really looking to trade before like 7:30, at least when I was trading. I'm not really sure if that's like similar to how it is now, but that's, how it was. And then the market would kind of close or settle down around 5. But then you would still have work to do afterwards. And then I would say, the credit space is still a relationship-based space, right?
Yeah.
Even with the introduction of all these technology platforms and third-party pricing and third-party trading platforms, it is still at the end of the day a relationship-driven market. So a lot of the time throughout the day was not only making markets, but interacting with clients. I was primarily over Bloomberg or over the phone. Like the goal would be to talk to like 30 plus clients a day. And it was like, what are you thinking? Getting trade ideas in front of them, talking macro, talking micro, and just like maintaining that relationship was really important, right? And that's still true to today.
Mhm.
What were your salespeople doing? Because I didn't realize that it was so client focused on the trader side.
Yeah, I think, the salespeople were, the bridge between traders, salespeople, and research, right? So especially in high yield, when you're looking at name specific, like the research team like plays a pretty big role, right? They're the ones who are like really looking at the meat and potatoes of the company. So the salesperson would sit at that intersection, and they would also be pitching like larger ideas. And listen, the salesperson's role was still very important, right?
Yeah.
They were like the front line to the client, but oftentimes trader to trader would have those relationships. So at like,
Wow.
even if you
So
think
you
about
were
like at
calling the traders
the
at like
traders
the hedge
at
fund. Interesting.
correct.
Got it.
Not
Okay.
necessarily like the portfolio manager, right? Whereas like the salespeople may interact more with the portfolio manager. It was more trader to trader. And
I
it was,
see.
and and it was a big part of the business. And
Yeah.
again, back then there were more players. So it was real money, it was hedge funds, it were arb desks, prop desks, and all the such. So like you would try and get a variety of market views throughout the day, and that would kind of help shape your picture on the market and like your risk taking appetite and whatnot.
Oh, that's so interesting. I mean, I find it fascinating that the perception is that bankers, work these super long hours, and you can go and be a trader and it's like a cushier job and it's less intense. And it's like, are you kidding me? You were getting up at 3:30 in the morning and you
That
were
was only
there
when I was
for
a summer analyst.
fair, but still you had to use, as you said, you were like, I had to be in on the desk at 6. I mean, if you're a banker, you're sometimes rolling in at like 9, in some cases 9:30 if you've had a late night, but it's like you're still there for 12 hours. So if you're a banker, you're there from like, call it 9:30. I mean, a lot of times you're there till 8, but it's like you get your free dinner and then you go home. Like,
Yeah.
and yes, you would have, I guess, a little bit of the less predictability, but I just find that so interesting. It's like it's still a really intense day. It's just shifted earlier.
And again, it's, that's at the analyst level. As you get more
Sure.
senior, like your hours kind of condense
Yeah.
a lot. And I had a far commute as a summer analyst. I
Yeah.
wasn't, most of my peers were, subletting apartments by NYU. I couldn't afford that. I come from like a blue collar background. Like I was using the money I was making to save, right? So it was a little bit different. So part of it was on me, but that was how the day started.
Wow. And one of the things too that I remember noticing, because again, I bounced around a lot, but fixed income, it's funny, I forgot that it was this OTC market because somehow it's like OTC and yet there's like a lot of holidays, whereas like,
Yes,
you
which
would
is
get
great.
more holidays in the fixed income world, whereas equity is like you got less, but it's crazy that it's like the market is open all the time. When I left fixed income for capital markets, and again, it was on the equity capital market side, I was like, where did all my holidays go?
Yeah. And I would say like those holidays are still staffed by the most junior people, right? Because they wanted somebody on the desk in case somebody calls and they need to execute this large trade. So I remember the night before Veterans Day, which was a fixed income holiday, was like a huge night for everyone to go out, right? Like everyone would go out the night before, and then the junior people would stroll in and kind of just sit there and, make sure nothing blew up. And if anyone needed a quote, they would get the right person on the phone to like, or execute the trade. So yeah, you definitely got a couple more holidays, but your hours are a little bit longer, I think, than in equities, right? The equity market has a set open and a set close. Fixed income, because of the over-the-counter nature of it, like you could, in theory, like trade at any point, right?
Well,
you could, in theory, you could.
Yeah.
It's funny though, I feel like nowadays, and I don't know if this is still the case, and I'm not sure if you know, but honestly, Jen and I were talking about this. Like, we don't know anyone who is like an equities trader anymore, who works in like equity sales. And maybe part of it is because Jen and I both started in fixed income. So like we know the fixed income people. But it does seem like, again, a lot of the equities stuff is maybe getting automated away a little bit more. Is fixed income not as much? Or would you say it still is? Or
I think portfolio trading is now, I think, making up about 10% of all trace volume. So that daily average trading volume. Portfolio trading is a little bit more equity-like in nature, right? So like you're sending over an entire portfolio and it's going to get traded in one slot. You are having a little bit more algo trading and systematic trading in fixed income. It is growing as a percentage of flows, but there is still, the need for actual traders in the seats, if that makes sense.
If you are a young person starting your career out in credit trading, what are the things that you think make someone a successful credit trader? How do those skills also transfer sell side to buy side and vice versa?
Yeah, well, I think because it's still a relationship-based role, like interpersonal skills is pretty important, right? You have to be able to talk to clients, get in front of clients, being analytical. I always like to say thinking mathematically, right? Like I liked math. I was the type of person who took calculus in high school and then chose to take calculus again in college because I liked math. Was I an engineer? No, but like I liked math. I liked thinking mathematically. So I think having an inclination to like think mathematically and doing like back of the envelope math, because at the end of the day, like your systems are doing everything for you. You just have to understand like the inputs, and putting the right inputs in there is important. Thinking mathematically, good interpersonal skills, liking the markets is really important, right? Like really liking the markets. I think liking reading is important because you are reading a lot more research than you are in some other roles, particularly when you go and move on to the buy side, right? Like you're understanding the credits and positioning. While ETFs and mutual funds, and there's more portfolio trading is a bigger part of it, I think still understanding fundamentals is important, right? And maybe that's just a sign of my age, but I think understanding fundamentals is important. Being willing to learn, having grit, having an appetite for risk. I think those are kind of all the main themes, but I think that's true for most sales and trading desks.
And where did you see people exit to? If people were leaving the desk and they were staying in the industry, where were they primarily going?
Other banks for the most part, or hedge funds. Right. So that's if they were staying in the industry, that was the move.
And was it mostly like credit funds, or was it, or hedge funds focused on credit, or was it kind of all over the multi-strat?
Yeah, I mean, they would be going into a credit role, right? So, but it would mostly like either like larger multi-asset funds or like credit-specific funds. Or sometimes like these pod shops, right? So there was like a lot of moves to like the pod shops, like the Millenniums of the world and as such.
Oh, yeah.
Makes sense. Well, Carissa, thank you so much. This was amazing. We're so glad to have you back. Hopefully you will be back yet again for another topic.
This is great.
We did talk for an hour before we even hit the record button. So
that's true.
Got enough material for many, many podcasts. But thank you so much. We always are so grateful for you. And I hope you have a wonderful rest of the summer.
And thank you for having me, guys. I very much enjoyed this as always.
All right. Talk soon.